Would you like to get some good deals? Would you like to find some very interesting companies with a long dividend growth history, but are not trading at crazy PE ratio right now? Well, you found the right video. Last week, I've reviewed 5 Canadian stocks that I think was undervalued. And this week, we're doing the same thing, but for US companies. For those who are new to the channel, my name is Mike Yahoo. I'm the founder of Dividend Stocks Rock, and I'm also a passionate investor. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. So today, 5 stocks. I'm going to tell you what they do and what I love them the most. So the first one is VF Corporation, ticker VFC. VF Corporation is not necessarily an regular apparel company. It's more like a brand manager. It started more than 100 years ago selling mittens. Kind of crazy, right? So over time, what management did is they acquired, improve brands, and then sell brands, and then do that several times. So whenever they find an interesting brand, they just acquire it, and now they improve it, make a lot of money of it. Sometimes they keep them for a while. Some other times they could spin off, they could sell them. Not too long ago, they made a major spin-off with Contour. You can see that actually in the graph. When the dividend was cut, it was not a dividend cut, it was just a readjustment because they spun off a part of their jeans business, so Wranglers, including in Contour. And now they have 3 major brands across their brand portfolio. So we have Vans, you have Timberlands, and North Face. As you can see on the graph, the dividend triangle doesn't look that bad. So revenue earnings are getting back up, recovering from the pandemic. And one thing that was quite interesting there is a lot of investors worried about the fact that shopping malls were closing, and a lot of those companies are depending on retailers to sell their merchandise, right? So in the meantime, they have developed direct-to-consumer sales, a little bit more online, and they did a lot of marketing. So this is why now it's going back up. The dividend continued to increase, but when you look at the P/E ratio on the graph, it is now trading at 13 times the earnings, which is kind of crazy, right? So we're talking about a company that has several years of dividend growth, that is relatively stable, has iconic brands across the world, and yet the market doesn't like it. The thing that I love the most is definitely their brand power. As you can see, have like the most popular brands over there, and they're all double digit big time. This tells you that the business is doing well and they know what they're doing. So not too long ago, they acquired Supreme, which is a great brand to blend in with Vans. They will have a similar target audience. They will have a similar market and branding. So I think they're going to be able to do something amazing. Actually, when they acquired Vans, they were able to just multiply and build that brand so strong. And it's now just a small bunch of skaters that are wearing Vans, but pretty much everybody. So their ability to manage and transform the brands into more profitable, into more mainstream is just uncanny. And for that reason, it's in my portfolio, and I'm ready to be very patient on this one, considering the overall business model. The next one on my list, it is one of my favorite stock all time. We're talking about BlackRock, the world's largest asset manager. At one point, they had over $10 trillion. Now the market went down. So they are 9 point something trillions of assets under management. Yeah, you heard me right. We're talking about trillions here. When you look at the dividend triangle, you can see that earnings and revenue are still increasing. The company has so many growth vectors, and we're going to get there to a moment, because this is the one thing that I love the most on them, is that they're not only dominating the market in terms of investment management, but they have several growth vectors over there. The dividend keeps increasing, I think, since 2010, so very good streak over there. But the P ratio now, we're looking at a stock trading around 17 PE ratio, which is one of the lowest level since 2019. definitely there's an opportunity over there. Back then, actually back in 2019, I was able to grab shares around $500 a share. Now we're around 600 something, which still seems like a big deal, big bargain here. Why? Because the company will continue to grow in the coming years. The first thing is they are not only the world's largest asset manager, but they are also the world largest ETF manufacturers with their iShares. ETF trends, I really need to convince you that it is something that is growing right now. It's just growing like every single day. There's always net inflows going there. BlackRock reported their latest quarter not too long ago at the end of July. Also, again, showing very important net inflows into their ETF solutions. So that is definitely something that will continue to grow. Their active their active managed funds are also very profitable, and they show a very strong performance. And when you're looking at that, when you're an institutional investor like a pension plan or something like this, and you have to manage like millions of dollars for your clients, you are looking for strong asset managers, those that will outperform their peers year after year. And this is exactly what BlackRock does. So it attracts new funds and it keeps them. So that's the name of the game. They're making money charging fees on the money they manage. So the more money they manage, the more fees they can charge, but they still have to perform, which what they do. Finally, one thing that I really like, because it's not about performance, but it's more about management. So you're paying that as a service, as a recurring bill if you're an institutional investor, and it's their Aladdin platform. It's a platform that will help portfolio manager to invest their money, manage their risk, do their calculation. It goes with a recurring payment, obviously, and there's a huge market over there. So BlackRock is an important player, but there's a lot of market shares to be grabbed, and Aladdin is one of the top platform in the market. So for those three growth vectors, I think that BlackRock, if you want to buy it now and think for the next 10 years, you will probably do a pretty good deal. So now moving on to a company that is far from being sexy, far from being exciting, but yet we need A.O. Smith. A.O. Smith is actually a water treatment, water heater company. So again, not necessarily something that you would like to be saying, oh my God, this is the next Tesla. It's not, but it is steady. It has very strong market share in North America and can grow in China a lot. I'm going to talk about that in a moment. But if you look at the dividend triangle right now, you can see that earnings and revenues are growing. They are far past the 2020 market crash. They have more than fully recovered. They show consistent dividend increases, and yet trading under a P ratio of 20. So right now at 18, we're going back to a valuation that was pre-COVID, which is quite interesting for a company that has nothing to do with COVID anyways. We need those type of the water heater, the water boiler, the water treatment is super important, and I think this is where you're going to find a lot of growth. When there was a tariff war with China, it was a situation that was a bit worrisome. Now the business is doing well, and they have a lot of growth to be done in India and in China, because water treatment there is very crucial. We live in a country in Canada where it is super easy to get drinkable water, right? But it's not the case across the world. And A.O. Smith has the size and scale and the products to go there in emerging markets and offer great solutions and dominate those markets as they do in North America. So for those reasons, I think this company will continue to thrive in the future. Pretty much recession proof on top of that. No matter what's happening in the economy, you still need to take care of your water, right? Moving on to another one that is a dividend king, but that had taken a beating over the past 5 years like there's no tomorrow. And we're talking about 3M. Let's be honest, it's about time that they do some cleanup. There was a lot of legal issues. Now everything seems to get settled. The market seems to like it. It's going to take a while. You have to be patient, but there's a lot of things going on. In the meantime, the valuation for 3M is just ridiculously low. So since 2018, it goes down and down and down. And now you have the opportunity to buy a company which has more than 50% of their products that are sold are repetitive purchases. So this is a huge source of recurring revenue for them. They are present across the world. It's like buying an ETF of industrial companies. 3M, the only thing that I'm worried about right now is that when you look at the dividend triangle, yes, it seems to recover in terms of revenue and earnings, but the dividend growth is slowing down big time. So I would be a bit careful with this one, but yet a dividend king that went through so many recessions, I am pretty sure they will find a solution, and actually they're already started. Not too long ago in July, they have declared that they're going to spin off their medical division, healthcare division, and they will concentrate on consumer, transportation, electronics, and safety and industrial sectors. So it's already a wide business with several brands, several divisions. So it may start to get a bit confusing at one point to manage all of that. It reminds me a bit of Procter & Gamble about, I don't know, like 5-6 years ago when they decided to sell a lot of their brands just to concentrate on the one that are most profitable. So 3M is doing something similar. I like the fact that they're going back into more focus, a bit leaner, and they will still remain, I think they were going to keep like about 19% of stake in their healthcare business. So it's not like they're selling it off completely either, but they're going to be able to focus on what they know best and let the rest being managed by another team, which I think will be very good. They are settling down also their lawsuits. They're taking care of that part as well. And once everything will be settled, the dust will come down, and then investors will realize, oh my God, 3M is just an amazing company that will be there around for many decades to come. The last one, but not the least, Air Product Chemical. When you look at the dividend triangle here, you may think, how in the world this company's stock price is not thriving, because everything is going up. It's like increasing its dividend clockwork. A rare company in basic materials that is able to do that, and this is due to their business model. They're selling industrial gases, so like hydrogen and stuff like that. So it's not a big part of their customers' budget expenses, but it's crucial. They need to use those gases to run their manufacturers and facilities, and for that reason, they are just going to continue to buy them all the time. And ATB is one of the largest player. Obviously, we're always talking about like huge players there, like Air Liquide or Linde. So those are like impressive and huge companies. They all have their market shares, but the thing that I love the most about Air Product Chemicals is they have massive investment plan already to generate cleaner energy, greener product like blue hydrogen. So they plan to invest $15 billion in the upcoming years. Several of their products are already ongoing, and if they can realize all of them, they already have the financing for that. They already maintain their credit rating for that, so you don't have to worry too much about the debt part, but you can now focus on the growth part. So ADP has decided to become a leader in those in this energy transition, selling better gases, like greener gases, if you can may think about that. And I love this move, plus the fact that it will generate a lot of cash flow going forward. Again, company that has been beating down the market. The market has been concerned the fact that they may suffer from inflation and get some pressure on their margin. But the thing is, Air Product and Chemicals, they are able to increase their prices on their gases. And they have done that over the past few quarters. And it has worked very well. So as you saw in the previous graph, revenues and earnings are doing fine right now. It's still a growing company. So while the market is taking a break, it is pretty much the opportunity for you to take a look at it, do your due diligence. Don't forget that those are not buy or sell sell recommendation. I strongly suggest you to do your due diligence, you do your own research on those stocks. Personally, I like them a lot. I have 3M in my portfolio, I have VFC, and I also have BlackRock. Air Product and Chemical is definitely on my list, but I haven't pulled the trigger yet. But fair disclaimer, I have like 3 out of 5 right now, so I may be biased, but I don't know. I'd like to know what you think about those companies in the comments. Let me know if you have found any other undervalued stocks on the US market, any other opportunities. I mean, the market is down almost 20%, so there must be some cool companies that we can buy right now that will help building our portfolio and be a little bit more comfortable at retirement, right? Next week, we're going to talk about timing. We're going to talk about if you should wait because now we're entering in a recession in the US. Well, technical recession, but still a recession nonetheless. The market's still going sideways. So should you wait to get some hints, some data that will tell you that the crash is over and now it's time to reinvest? So we're going to talk about that next week. And until then, don't forget to stay invested.